Hi everyone, in this video I'm going to talk about the cash rate, what is it and how it affects term deposits, bank accounts and shares. For those of you that haven't met me, my name's Angela. I am your money messenger. My background is in financial planning. I've been in that industry for over 20 years. I help financial advisors to prepare recommendations for their clients about how to repay debt, invest, and grow wealth. I'm also an investor myself. Everything I teach you, I do myself. In today's video, I'm answering a viewer question. It comes from Pat in Melbourne. Pat wants to know, what is the cash rate and how does it affect term deposits, high interest bank accounts, and shares? Great question, Pat. Thanks for writing in. The cash rate is established by the Reserve Bank of Australia, the RBA as it's known. It's the central bank in Australia and it's in charge of all aspects of monetary policy, such as currency, overall employment, and just the general financial prosperity of Australia. The RBA sets the cash rate, which is essentially the rate that commercial banks, such as Commonwealth Bank, Bankwest, ANZ, that they can borrow money at. The RBA meets on the first Tuesday of every month to set the cash rate. To give you an idea, the current cash rate is 0.25%, which is quite low, the lowest I've ever seen in my lifetime. As an example, a year ago, the cash rate was 1%. So the Reserve Bank meets to increase or decrease the cash rate depending on what they want to do with the economy. If the Reserve Bank wants to put up interest rates, that means that they're trying to soften the economy. Perhaps the economy is growing too fast, causing inflation. They just want to bring it back a little bit, so they put interest rates up. Now that effect is twofold. It makes the cost of borrowing more expensive. So your home loan, for example, interest rates go up, your interest costs will be higher. That then slows the economy down. But it also means that any interest that you're earning on your bank accounts, your high interest bank accounts, or term deposits also goes up. So you earn more interest income, but your home loan repayments might be more expensive. The interest might be more expensive. So because borrowing money is more expensive, that's usually more powerful, more costly, it will soften the economy. When the cash rate is reduced, the RBA is trying to stimulate the economy. If cash rates go down, generally banks will pass on the savings, so a person's home loan interest rate may go down, for example. When interest rates go down, borrowings become cheaper. The idea is that people then borrow more money to stimulate the economy by buying household purchases or property. So you can see with a year ago, cash rate was a lot higher. It was 1% versus 0.25% now. That means that it was more expensive for banks a year ago. So interest rates for home loans were higher. Interest rates for bank accounts, term deposits, high interest accounts, things like that, was also higher. So you're getting more bang for your buck in terms of interest, but your home loan interest may have been higher. Over the last year, we've seen the economy was a little bit slow in Australia. Then COVID hit earlier in the year, so that really mucked around with the economy. So the Reserve Bank has been lowering interest rates. So how does the cash rate affect bank accounts, term deposits, and shares? When interest rates are higher, you might notice that you're earning more money on your savings, particularly in a high interest account or a term deposit, which will pay higher interest rate than a normal everyday bank account. However, when interest rates go down, those rates will go down that you'll earn on your income, on your investments, your bank accounts. However, the relationship between the cash rate and the share market is a little more indirect. When the cash rate is reduced, for example, interest rates are lower, the share market seems to do better. It seems to improve. Now that's for a number of reasons. Number one, there might be more investors flocking to the share market. If people, particularly say retirees, are really reliant on the income that they're earning from their bank accounts and their term deposits for their income, if they're reliant on that and interest rates are low, they're not earning as much as they were on their bank accounts as they were in the past, they might then turn to other types of investments such as shares, chasing a higher return, potentially chasing the dividends that shares can pay, which are usually much higher than they will be for the interest rate attached to a bank account or a high interest bank account. Also, when interest rates are lower, cash rates lower, that means that it's cheaper for people to borrow, but also cheaper for companies to borrow. So that can stimulate the share market. And when comparing bonds to the share market, now bonds are essentially fixed interest term deposit for argument's sake. When the cash rate is low, they're not doing so well because the interest that they pay is quite low, so their value is low. Conversely, share markets may then be worth more. The value might be higher in the share market purely because the bond market is lower. So people go towards shares. That then pushes up the share market. So in this video, we talked about what is the cash rate and how it affects bank accounts and the share market. If you like what you saw and want more videos like this, please don't forget to subscribe, give it a thumbs up, and let me know what you thought about the video. Pop a comment in the box below. I also want to let you know that my new book is now available. It's called The Money Messenger. You can get your copy on moneymessenger.com.au. In that, you're going to find more of my secrets and strategies when it comes to money. Thanks for joining me today. I'll see you next week with a brand new video.